All right, so just a little bit about me for those that don't know me. This is obviously benefiting the recording, the people that are watching this later. So we have, I'm Sean Lowry. This is my investment company, Timber Run Capital. Feel free to check out gotimberrun.com just to get a feel for my approach to investing in multifamily. I usually will post articles, be posting interviews on there, just informational goodies for anybody that's interested in this space. But I wanted to show you this message from me to highlight the whole purpose of this. So really, the way my brain works is analytical. So this comes natural to me. And I wanted to do this today, not only to help anyone out there that's interested in evaluating or getting a sense. I think one of the main questions I get is, well, what's the first thing I do? Well, it's a tough question. It's different for everyone, but let me just give you an idea of, all right, we have an opportunity you're considering, whether it's something that you're looking to buy yourself or something to invest in someone else's deal. I think highlighting some of the ways that I myself, as a deal sponsor, someone that offers investment opportunities to others, myself included, how I approach it, and just to give some ideas, maybe something will jump out to you that'll be beneficial. So one of the main things is patiently evaluating properties. So over the past year, or in 2022, I evaluated where some of them were snap judgment no's. I was not interested. It wasn't the asset class I wanted, the location, a property type, whatever. And the ones that I actually dug into, which the process I'll show you today, was over 100 of them, over 100 of them, 15 offers came out of that, letters of intent, and 0 offers came to fruition last year. And that's okay. I'm patient, opportunistic. I'm looking for value add opportunities, which means properties that have either revenue that can be increased or expenses that can be decreased or some combination therein, or even more creative ways to approach it. But again, just to keep it simple, that's what I'm looking for, seeking value-driven returns, pairing the property with a high-quality loan. And if you can appreciate over the past year, the fluctuation in interest rates has caused quite a challenge for any investors that had floating rate debt. So my preference is to have longer-term fixed rate debt. It just depends on the deal. So again, that's a whole other topic of conversation, but I'm looking to pair it with a high-quality loan, which for the benefit of the protection of my investors and the deal overall, longer-term debt is certainly a strong area for peace of mind. But anyway, and then capital reserves. So one of the things I'm going to highlight today is something that you never see on an offering from a commercial broker or a residential agent is, well, gosh, it might cost money to actually improve the property, or you might want to have some money set aside for the what if. That's an element that you want to factor into your evaluation to account for that additional capital you need to raise, because that will impact your returns. And then, of course, selling or refinancing when appropriate. So let's go into today's sample deal. This is a real life deal. This is one that I had pursued, and I can't see my screen, so bear with me. Where is it? Not it. No. There it is. All right. So I was thinking, do I just cover a single family, a duplex? Doesn't really matter. The same process for me, no matter what it is. Obviously, some things are going to be different. This is an 11-unit building in Phoenixville. And as I mentioned, for anybody that's on, feel free to just type any questions into the chat box if you have any. Feel free to chime in. I will ask have a quick Q&A at the end. Like I said, I want to keep this 20, 25, 30 minutes max. So I get these all the time, and I will be able to quickly decide based on my criteria, which is an important point for anyone out there. Make sure you have a general sense of your criteria. It'll allow you to say no a lot easier, and saying no opens you up to the next opportunity. So for me, I'm looking in suburban Philadelphia for 10 to 75 units. This is an 11-unit in Phoenixville. I live in Phoenixville. I'm certainly interested. Vintage or the age of the building, I'm looking for 1950 to 2010, roughly. This is 1960 or so. All right, so immediately I'm like, all right, I am interested enough to look at this. So let me spend a few minutes of my life taking a peek, get through some of the fluff. All right, cool. So value add potential. Here's the price right out of the gate, $2 million, price per unit, 181. So you're getting some of the basic information here. Is sometimes they don't even, the broker may not even indicate the price. That's okay. Usually if you just ask, they'll tell you, or a whisper price, or as it may be called. But just trying to get a sense. In this case, they told us the seller is listing this at $2 million. It's 11 units. That's the per unit price. Now, in my mind, having done this as much as I have, different areas, I have a general feel for what a building like this would historically trade for per unit. So in Phoenixville, 180 per unit is not unheard of. I know right out the gate, it might be a little challenging for me to make it work, but over time, the values have increased to the point where this is top end of the range, but feasible. So still worth looking at. So now I'm going to go down to the financials. So for the sake of our topic of interest today, which is evaluating, let's evaluate. So you're going to get financials, a varied amount of financials from whatever seller or agent or broker you're working with. In this case, pretty common to get a profit and loss statement, or what's called a T12, which is just the trailing 12 months of profit and loss. So right here, I see, all right, current in-place rents. What are the rents today? On average, from the one bedroom, one bath units, $1,080 per month. Two bedroom, one bath, $1,367 a month. I know just having owning property in Phoenix told that that's certainly a little below market for that type of unit, for that size unit. And the agent will say, all right, well, I think we can get rents up to these numbers. So 1,700 for one bedroom, 1,975 for two bedroom. Cool. I appreciate that. I'm going to validate that. So you, as the investor, want to trust but verify. So in this case, I just make note of it in my mind. I pop it into my spreadsheet over here. Now, let me know, can you see any of this, or is this screen way too small? Because I can zoom in, I'm sure. All right, so I popped in over here. Now, keep in mind, this spreadsheet, this is a friend of mine, Michael Blanc. He created this. It's called a syndicated deal analyzer. To keep it as simple as possible, there are definitely more simple analysis tools out there, such as on biggerpockets.com. You can create your own. I was going to reinvent the wheel and create one for you today. I chose not to. I'm just going to use what I always use because I'm most familiar with it. Definitely is a little more complicated, way more complicated than most investors would need. But maybe you'll see a nugget, something of interest. And if you want to talk more about this with me, just let me know. Or you can check out Michael Blanc, B-L-A-N-K. You can Google his name. You have to pay for this. I think it's $125, something like that. But as a syndicator, someone that raises capital from other investors to buy deals, this is a phenomenal tool for me. So on the basic level, I'm going to start on this left side column here. So when I first look at what the agent, owner, broker provided to me, I'm going to pop it into this column here. So asking price, $2 million. Purchase would be, well, what can I pay? I'm going to back into that number in a moment. Number of units, 11. Down payment, typically for a bank loan, in this case, like something like Phoenixville Federal Savings Bank or something like that, a local bank, regional bank, or a larger bank. You're typically putting 25% down. Are there variations? Absolutely. You can get more of a hard money loan that might have lower down payment, might roll a bank loan, or hard money might roll in some of the rehab costs. I'm just going to keep it simple. We're going to say 25% down on the purchase price. Interest only, I'll talk about in a moment. That just means for the first X number of months, you're only paying interest on the loan, which if you think about it, for a value add where you have to go in and inject capital to improve the condition, you're going to have some empty units. So your income is going to be a little bit lower at first. So if you can get some interest only at the onset of the investment, it helps you maintain a positive cash flow ideally. So that gives a loan balance of 1.5. Let's ignore the repairs and reserves that we might need to. So again, I'm thinking from raising from myself and other investors, but to keep it simple, let's say it's you have the wherewithal to purchase this on your own. So it's you with your money. Fantastic. So right now, the broker said, or didn't make any reference to dollars for repairs or capital improvements. So we're just going to keep it zero. We're just mimicking what is provided to us. Our income, we go down to the historical operations. So the income that was provided to us by the broker was $161,550. So you have your gross revenue, you have your operating expenses. That's what we're going to look at now. Gross revenue includes your rental income, and there might be other income such as pet fees, late fees, utility reimbursements. In this case, it's pretty straightforward. The owner had $161,000 in rents, and that's net of any vacancy, that's net of any collection. That's what he, in theory, actually received in calendar year 2022. And fees income or other income, that's being reported $3,125. All right, so I put that into the spreadsheet. So far, I have the price. I have my 25% down payment. We're mimicking the income, at least close to it. And now we're going to go down to this is the quick 5-minute review. Total expenses, rather than me punching each line item in, this is just my first pass. I'm just going to basically total it at the bottom here. So what are my total operating expenses, which doesn't include the mortgage? This is just going to be the cost to run the building. What was reported by the previous owner was total expenses here of $53,828. So again, I'm not even worried about the detail of all these. Do I believe in them? Are there expenses that are omitted in my experience? We'll talk about that in a moment. So the first thing I look at, all right, expense ratio. So total operating expenses as a ratio to the total gross income. In this case, it's 32%. So rules of thumb for a 1960s 11-unit building in this location where the owner is paying the utilities, except for maybe the electric in the building, would typically run about 40 to 45%. Now, you may not know that without being experienced, but again, as a quick rule of thumb, I'm thinking to myself, all right, well, the buildings that I own that are similar to this, and just from my experience in educating myself over time, I'm expecting the expense ratio to be closer to 40 to 45% for a well-run building. It's 32%. So I'm like, okay, well, that's interesting. It's certainly going to make the overall net income and cash flow look better, but do I believe that? It's possible, but let's look closer. So now I'm looking at, all right, I did my first pass. Don't worry about what the details of what I'm doing here. Like I said, if you were interested in learning about the sheet, I'm happy to spend time with you. But I'm just looking at what is my cash on cash return? Cash on cash is the dollars that you invest. How much cash flow are you getting on average over the course of holding that building? 11%. It's pretty awesome. So cash on cash return, in my experience, especially from a syndication standpoint, where you're chopping up equity between the sponsors of the investment offering and the limited partners, typically is 6 to 7 to 8%. And this is at 11 to 12. So I'm at least interested enough. Everything I've seen so far, even though I have some questions, I'm going to dig into this. So that's the first pass. Now, if you have something like this, you're not sure how to, even with this still might be confusing. Just hit me up. I'll be happy to help you. No expectation, anything in return. Just be happy to offer my time to help you out. All right, so now I'm going to go to the next version. I call this my version, my version of the truth. So I'm keeping my offer price the same. I'm not ready to back into that yet. Obviously, most of this information is the same, 11 units, 25% down. The repairs. Now, I have either seen photos of the inside or toured this building. I know just from my experience what it's going to cost me to upgrade to the standard for that area. And I did the math over here. So I'm not going to bore you too much on the details here, but I'm not just going to guess at it. I mean, you can use a per unit dollar amount, which I do as a first pass. And in my experience, it's usually like $10,000 to $12,000 for a basic rehab. If it's a total gut, it's going to be more. If it's a very basic cosmetic fix, it's going to be less. But I'm totaling $194,000 in rehab. I'm also accounting for future capital improvements. The roof, what is the condition of the roof? The parking lot, the sidewalks, the water heaters, all that stuff. I'm not going to look at the line items here, but just know that you have to think about all these things. The broker is typically not going to include that, so you have to include that in your analysis. If you don't account for the money that needs to be raised or the money you need to bring, because we're thinking of you have the money to do this. It's just you as a sole investor. These are real life expenses. So one of the biggest learning lessons I had starting this years ago was, oh my gosh, all these expenses that truly exist, they're certainly not mentioned by the broker because they want to make the deal look as good as possible for the seller. Common sense would tell you, all right, well, if it's a 1960 built building and the condition of the inside is from 1960, guess what? For me to maximize rents, I'm going to need to make improvements. So that's over here on the next line, but it totals $214,000. And operating reserves is typically like what my property manager will just kind of set aside. You can set it aside yourself. That's just for things that might pop up outside of the course of normal operations, just added buffer. All right, so for this one, I'm mainly focusing on expenses. This is kind of a closer look at, all right, so based on what the owner reported for his line items on expenses, where do I see any discrepancies? Can I justify the 32% expense ratio, or am I coming in higher or lower? So now that I know I'm interested enough to dig into this, let's dig into it. So we have what the owner reported here on the left column. Real estate taxes, I mean, they are what they are. You can verify that on county records, 16,000 and change. So one thing to point out, and this is mainly for larger buildings. So the school districts in the counties of Pennsylvania, outside of the city, I'm just not sure how the city works, have the right to spot appeal any building, any owner of a building, whenever a property trades hands. Because what you think about from a tax standpoint, the county tax assessor did a countywide tax reassessment in this case, Chester County, I think in the 1990s. And they have not done one since yet. It will happen again. But what they do is they have to make assumptions. So when the property was assessed back in 1995 or 98, whenever it was, at that point in time, that was what they assumed 100% market value to be. Obviously, that market value changes over time. And since your taxes is a product of what your market value is perceived to be, if your market value has increased substantially, or what you pay for the building is substantially higher than what they think the building is worth, there's a risk that there could be a reassessment. It just happened to me on a 14 unit I own in Pottstown this past year. So with that said, what I want to do on buildings of this, and typically the threshold that the school districts will look for, and this is pretty irrelevant unless you're looking at 10 plus unit deals, but it's 100,000. Every school district's different, but from 100,000 to $750,000, if there's that much of a difference between what they think it's worth and what you pay, and they could verify that, what you paid, then they have the right, but they're not the obligation to assess or appeal your taxes, and it could potentially increase it. So down here, I created this where I calculate, all right, well, they think the building's worth $877,000. They, the county taxing authority. So think about that. The building's listed at $2 million. Let's say I paid full price. The tax authority thinks it's worth $877. When they see that $1.1, $1.2 million difference, and the school district is fighting for every dollar they can get, rightfully so, there's a chance that you get appealed. Does that make sense? Hopefully it does. But let me not go into the details of this, but what I do is from a conservative point of view, if there's enough spread, in this case, I look at if I paid $2 million, without going into detail, typically you can negotiate with the school district to not charge you taxes based on that high of an amount, just be a step up. Long story short, there's a $300,000 difference between where I think they would look at it and what they think it's worth today, which could be above the threshold for that school district. So I'm just going to account for an increase in taxes, long story short. Many times they won't appeal you and it's not an issue at all. And this makes it harder for me to win deals, honestly. But the last thing you want as an investor is you get under contract in the building and a year or two later, you get a tax bill or interim tax or appeal, excuse me, for taxes to be $5, $10, $15, $20,000 higher than you anticipated. It just absolutely destroys your cash flow. So just something to factor in, especially for larger buildings. So for sake of now, I'm just going to say, well, this is what it is today. I verify that on county records. Insurance has gone up significantly over the past year or two. So again, rule of thumb in the past used to be $350 to $400 per unit for an annual insurance premium. The owner is saying it's $52.46 is what he paid. 475 is the 450 to 475 is what I'm seeing today for the estimates I've received recently. So that's in line with what he is actually paying. So I'm good with that. Gas and electric, it's gas and electric. I mean, it's not going to change dramatically. It's more weather related, which I have no control over as much as I think I do. And then water and sewer is another opportunity to potentially add value by decreasing expenses. So I'll use, he reported 73.85. I know, owning a building in this town that my average water bill is $45 to $50 per unit per month. So if I do the math over here, $50 per unit, so $50 times 11 units times 12 months out of the year, I believe I should be closer to 6,600. So I can get it down $700. And what does that typically represent? In my experience, a small leak, toilet that's running, something that's been overlooked. So when I go as soon as I take over ownership, I go through every single apartment and look for those leaks. I look in the basement. And on the one at Pottstown recently, 14 units, we found 3 or 4 leaks, including a toilet that was running, and we reduced our water bill by half. So we went from $90 per unit to $45. It's a substantial savings. It increases your NOI. So if you see the water and sewer bill above that $45, $50, $55 per unit mark, it might indicate that there's potential to get that down. Or not. It just depends on the municipality and the age of the building, et cetera. Trash removal, that's trash removal. I'm just going to trust what he's paying for now. Contract services, that's your snow removal. That's your lawn service. That might be pest control. Things like that, it's a recurring basis, but it's not a fixed expense. I have my own formula for calculating that. So I'm coming closer to $47.50. So you're thinking, like, how much is going to cost to cut the grass? It's a multi-tenant building. So a tenant probably is not going to do that. If it was a single family, probably would put that on the tenant. Multifamily, you as a landlord have to have somebody take care of that for you. You're paying for that. Lawn care, snow removal. Obviously this year, I don't think I've cleared my parking lots more than once with salt. So it's going to be a very low year, but other years can have 10 to 15 snow removal sessions, and that could cost. So you're getting ahead of trying to guess what it's a guess. It's an educated guess. Advertising for this size building, and typically I'm not going to invest dollars into advertising. Don't need to at this point. Professional fees, that's your accountant. That'd be legal fees for eviction. I'm just going to keep it at 0 to keep it simple for now. Management fees. So the owner reported nothing for management fees. Now, is that realistic? Even if you self-manage the building, I would recommend you put something in here. I don't know why it's showing 0, but let's just move on because I'll go over here for a second or in a second. But, for a single family house, you might pay 7, 8, 9, 10% of your gross income for a management fee. For an 11 unit building, you might pay 6, 7%. For a 100 unit building, you might pay 2, 3, 4%. So in my experience, I'm usually about 6, 6.5%, but the owner is not reporting that at all. So if you overlook that, and even if you were going to self-manage, think about when you go to sell. If you're going to sell it to me, I'm going to have that professionally managed more than likely. Even if I self-manage, I'm still going to charge the building a fee for the service that I'm rendering effectively. So that was overlooked by the broker, and I want to add that in. Repairs and maintenance, again, I use a rule of thumb for this. The owner reported $10,000. I'm thinking typical for a 1960s building that's not been rehabbed yet, 5% of the gross income. It's going to vary, obviously. But once I rehab, my plan is to go in, rehab these units. So by the end of the rehab period cycle, I'm probably closer to 3% of the gross income. That could be 12,000 one year, it could be 0 the next year. It's going to vary, but that's just rule of thumb in my mind. So this seems a little bit high, but it's also been a building that hasn't been upgraded. So it's possible. Turnover expense, this is for a tenant moves out. You're going to send somebody in for touch-ups, paint. Now, can you get some of the security deposit from the tenant to offset those fees? Yeah, probably. In my experience, I'm still out of pocket $550 to $650 per unit every time a unit turns over. So I'm accounting for that. Again, I don't know why it's not popping up here. But I'm just talking you through each of these line items. So I'm comparing what the owner or the broker is sharing to what I think is the version of reality. General and admin, that's your rental license fees. That's other things that might pop up from your municipality typically. Any other just random administrative things. And your deposit or replacement reserves. This is just money that you are proactively setting aside for future what ifs, for future capital improvements. So we're budgeting all these things for the operating expenses. But again, what about the water heaters, the roofs, the major components? Yeah, we did raise some money up front, but typically the rule of thumb, $250 to $350 per unit per year that you set aside into a reserve account. So being that this is showing 0, I'm just going to jump over to my projection. So I had it for the sake of time. So now as a value add investor, I'm thinking to myself, all right, where can I take this building? That's where it's at today. Now I want to think, where can I take this? And then back into a price that I can pay. So the only difference is that we're going to say here, all right, well, now I need to factor in the cost for the rehab. So I showed, and you can use a rule of thumb, a per door cost if you have that in mind, or I broke down an itemization based on my plan for the building, and it comes out to $214 over 11 units, whatever that math is. That includes the capital improvements, the parking lots, the roofs, the windows, which this building needed some upgrades along with just the interior renovations. Operating reserves, just a little extra buffer. So now I'm going to show what's the rent that I can get it up to. So as I mentioned initially, in-place rent averages $1,237 per unit. Based on my research, which again, plenty of ways to approach this. This is not the simple way to look at it. Use common sense. You can look at Zillow. There's a website called Rentometer or Rentometer, which is you get a few free uses that you have to pay for it. Apartments.com. There's so many sites out there where you can get a good feel for comparable properties, similar age, similar size, certainly the same bedroom and bathroom count, ideally the same amenities or lack thereof. So if you can find a handful of buildings in that area, I made adjustments, but for simplicity's sake, let's say you did your comparable search or you asked your broker for help on that. I'm breaking out to 1 bedrooms, I can get up to $1,515. I'll round that up. 2 bedrooms, I can get up to $1,791. I'll round that up. So now I can take rents from today. When I buy this, or you buy this, you're at $1,237 going in with a projection year 2, year 3 to get it up to $1,675. That's the value add component, along with the expenses that we can reduce. So now I'm showing, all right, well, this is the revenue that I can generate. I want to account for a vacancy factor and bad debt or people that don't pay their rent. So usually the industry average is 5% as a rule of thumb. Rarely do I ever have vacancy at 5% outside of the rehab period. You still want to account for it. And then the other income, again, that's so when I approach this without showing you the calculation, I'm just saying 750 per door per year. But this is things like some areas I can justify charging the tenant for utility reimbursement. It might be a landlord paid building, such as I'm paying gas, the heat for the building, I'm paying the water. I might be able to charge the tenant back for some of that. There's different ways to approach it, but just know that in some areas that is more acceptable practice than others. In this area, I can do it. So I'm going to charge a portion of the utilities back to the tenants. I am a pet friendly landlord, so I would have an assumption for some pet income. I don't want to factor in things like late fee income or security deposit retainment, things like that, because I want to think that I'm going to run this building so well that I'm not going to have tenants that are recurringly late. So I don't want to count that as real income. So you certainly want to look at the other income that's provided to you by the owner and just cut out any of the nonsense that shows that it's a mismanaged building, because you really shouldn't have those in there. All right, so I'm going to use once I'm done the rehab, I'm going to think the school district is going to attempt to appeal the taxes. I'm going to pay a little bit more. Again, rule of thumb, I'm usually 10 to 13% of the gross income as a real estate tax. And this shows 9%. It varies widely, but this is what I'm using as a reference guide. So we talked about all the other items. We're making the changes that we discussed. I'm putting the management fee in there. Payroll and leasing. Now, there's not payroll. Payroll would be if the building's large enough to justify having on-site maintenance, on-site leasing staff. An 11-unit building won't have that. So you're subbing that out, hiring an agent for the leasing or doing it yourself, or your manager is. But there's a cost to that. So the management fee might be 5, 6, 7%, but the leasing commission typically would be extra. There might be a markup on repairs that the property manager oversees for you. There might be other fees that you have to talk with your manager and get a really good feel. And that's something that is always overlooked in the offering packages that are sent by brokers. Because in theory, if you were doing it yourself, you may not have to incur those costs. But again, I'm looking at this from a business owner perspective. I want to hire out things that I don't want to do. So there's going to be a cost to that. So there might be a leasing commission of half a month's rent up to a full month's rent. That's something that's negotiable. It's something you discuss with your property manager or your real estate agent if you're hiring somebody to do that. So it's a real life expense. It adds up quick when you're turning over 11 units the first 2 years. That's 11 leasing commissions on top of the management fee. So something you want to account for. Repairs and maintenance, once it's fully rehabbed, I've made the improvements. I'm going to be down closer to 3% of the gross income. My turnover, again, as units turn over, some people just lump that in with repairs and maintenance. In my mind, I'm thinking it as a separate line item. That's typically 550, and I'm assuming turnover of 1/3 of the building will turn over each year as a rule of thumb. All right, so when you break it down, my expense ratio, once the rents are up as high as I can get them, the market's willing to bear, my expense ratio is 34, 35%. Now, I told you earlier, I'm thinking 40 to 45%. That's for when I'm taking over a building. Once the rents are up, you've executed your value add business plan, that ratio will come down closer to 35 to 40. So hopefully I haven't lost all of you. I know I enjoy talking about this. So hopefully you got a nugget here or two. So interest rate, obviously this varies, depends on the loan product you go for, depends on the day of the week, the hour of the day. But as of late, they were down to 5% a couple weeks ago, up to 6.5%, somewhere in that range. 6%, your amortization, 25 years or 30 years, depending on the product you're going after. What does that mean then? So the other, I'm looking over at my projected returns now. So if I paid $2 million for this building, now this says if an investor put $100,000, let me go up to here. So the building as a whole would be generating returns of 4% year 1, 6% year 2, 9%, and goes up from there. This doesn't seem right. Hold on. That's why. Those are completely incorrect. Ignore everything I just said. There we go. All right, so cool. You went through your evaluation process, and now we're gonna all right, what kind of returns am I going to see? Well, 0 year 1, 1% year 2, 4% year 3. All right, well, that's not very enticing for me to pursue this building. For the sake of time, I'm not going to go into too much detail here. This is more for how I approach displaying the upside of the building. But I'm just going to skip over this part. This is showing that there's going to be a little bit more vacancy years 1 and 2 as I'm having empty units that I'm rehabbing. Then it'll get down to where the 5% is. The loss to lease just means how much are rents below market today. I'll be burning that off or getting that gap narrowed as time goes on. At the end of the day, we're looking at, all right, well, what kind of cash flow are we talking about? So do you want to buy a building for $2 million? If you agree with what the process I went through and these numbers, and you're going to get minus $286 year one, you don't have to answer that out loud. Just think to yourself. Well, it depends. What type of investor are you? Are you a cash flow investor? Are you a speculative investor? Are you looking for just the upside? I'm a cash flow investor, especially when I have other investors investing with me. I don't want to have negative cash flow. So what this tells me is that if I believe in the rents, I believe in my operating expenses, my assumptions, I verified the debt that I can get on the property through a term sheet from a lender. I'm not happy with minus $200. Now I need to change the price. So I'm going to go up back here to my projection and let's play around. I'm going to back in. So let's see if I can buy it for 1.9. Does that improve my cash flow enough? Now I'm at 48.89. All right. And on a percentage basis, that's under 1%. So, but again, value add is going to start low with your returns and work their way up. Once I'm fully stabilized, in a sense, once the rehab is done, I'm at 5%. All right, well, I know that 6, 7, 8% is kind of commonplace from my experience in this market today. So I want to get a little bit higher if I can. So let me try 1.8. And this is the process I go through. So in simplistic terms, you have your revenue, you have your expenses, you want to project where the building can go. So you're verifying where rents can go based on your research. You're getting a feel for the expenses that were presented to you. Make any adjustments as you see fit to reveal your version of what reality should or could be. And you can talk to your property manager too to verify these things if you have one. You talk to your lender, you talk to your insurance agent, you've done your inspections. Everything's good now. We're good with all the assumptions. Now we're just trying to think, what can I offer? All right, so 1.8 gets me to 6% by year 3. All right, so let's just say I'm good there. Now, I know the first couple of years returns kind of suck, but for value add, it's not uncommon. That's lower than what I'd want to be, but for purposes of this conversation, this is the approach I take for a building with upside. If this building was 2020 built and there's nothing to do to it, it's going to be it's going to be the same process. There's probably not much upside in rents. There might be some. The expenses are it's just going to be more stable return. So that's a matter of, can it get to a high enough level out of the gate? You're going to have a higher return out of the gate, but it's not going to increase as much as this would. So cash flow for year 1, I would be at $10,000, 23,000 year 2, 46,000 year 3. It's a 1% return, 3% return, 6% return. All right. So if I want to end at 1.8, maybe I offer a little bit less than that. I talk to the broker, feel them out on the seller's motivation, the level of competition. But that's the gist. Let me see if there's anything else. I mean, there's other fees that are built into this spreadsheet, is why I like it. So you might have attorney fees, especially if you have partners and you need an operating agreement or entity formed. You might pay an inspector. You have your appraisal, lender fees, title insurance and transfer tax. You might pay your insurance upfront. So all typical closing costs, whether you're buying a house or an apartment, they're pretty much the same. And the excess, this is, I'm just not, I want to assume that I'm going to sell this, because then I want to account for what kind of proceeds I can get from the sale. And in this case, I'm going to assume that the market will be, I'm always going to think in my mind, the market will probably be a little bit softer than it is today, to be conservative. Depends on where we're at in the market cycle. But I believe, based on the improvements I can make, I can sell this for 2.7 million. I paid 1.8. This is year 5. I paid 1.8. I can get $600,000 plus from proceeds from the sale. And my total internal rate of return, this is very elevated. Again, this is a quick pass, 17%. IRR is, I love that metric. It's a great way to compare to investment opportunities, more apples to apples. It accounts for the time value of money. It accounts for when your cash flow is received. So think of it this way. If you received $100,000 from this building over 5 years, cash flow each quarter for the first 5 years, and then proceeds from the sale, versus if I was building a building from scratch and say it took 5 years, you receive no cash flow, and you get a big payout at the end of year 5, 100,000, same amount. Your IRR for the existing apartment will be higher because you've been receiving money all along. You received money sooner than you did if you're waiting for a development project. That's another conversation too. I better stop there. So I hope that helped. Let me see if there's any questions for the brave souls that are still on the call. Chime in or type, please.
Hey,
I don't know how to
hi.
see if anybody's typing anything anyway. So if you are, I may not even see it.
Hey, hi. Hey, this is Philip. Thank you very much. That was very interesting, very informative.
Thank you very much.
I guess one question is, do you normally aim to sell after you've improved the property and increased the rents? Do you normally aim to sell after 5 or 7 years, or?
I mean, my goal, obviously, it's going to be different for everyone. For me, it's ideally about long-term passive income. So my goal is to achieve financial freedom, to help my investors achieve the same or supplement as much of their income as they want through this method. So ideally, it's going to be and it's going to be tied to the loan too. There might be loans that there's loans that are 12 years fixed term that would be a significant prepayment penalty if you try to sell it sooner than that. And there's other loans that are 5 years. There's loans that are shorter than that. So it depends on the loan term, depends on the strategy I have for the building. So I typically would hold it. I'm looking to hold it 5 to 7 years for a building this size. You kind of reach a maximum with how much you can squeeze out of it. And then as you're building equity in the building, you're going to want to either pull that equity out from a cash out refinance, sell it and do a 1031 exchange, which is tricky with multiple partners, but can be done, or just sell it and cash out altogether. So it depends. Ideally for me, the building size I'm looking for would allow a 5 to 7 year hold. But for example, I'm looking at a 4 unit deal tomorrow. That the goal would be to make similar improvements as we're describing here, but it's not really a cash flow play. It's more of a longer term flip, so to speak, that we can 1031 into a slightly larger building. So there's different ways, but typical deal for me, 5 to 7 years.
Okay, thanks.
Yep.
I suppose the related question is, from the point of view of an investor, therefore, should the investor stay in for 7 years as well?
Yeah, that's a good point. So it's like you have way more control when you're buying your own building. You can do whatever you want. Obviously, restricted by any loan terms you have. As if you're a passive investor in an offering in someone else's deal, it's pretty illiquid. You would have to. Those are questions you want to ask, Philip, as far as how long will my money be tied up? Do I have
Yes,
access to my
yes.
money at a certain period of time before that? Typically, no. It can be done, but it might cost you, and it's an arduous process. So if I have a projection for something that I present to you that's 5 year hold, I would expect to have your money locked up for 5 years. Obviously, you're getting cash flow. There might be an opportunity to pull some money out and get you equity back sooner, but you're not going to see the lion's share of your money back plus the profit until the end of that period
Okay,
in
thanks.
most cases. Yep.
Yep. Okay.
Hey, Nick, good to see you too. I can't see you, but if you're there, hi, thanks for joining. Any other questions for now? So this is the kind of thing where if you come across anything and you want to bounce questions, ideas, thoughts off me, please do. Go to my website. I'll just type it in here. GoTimberRun.com. You can contact me through there. Give me my cell for anybody that is here. And furthermore, some of you probably received my email earlier today. It might be why you're here for March's in-person meetup in March 15th. It's going to be in West Conshohocken, and it's going to be a more intimate group, 20 to 25 people. I have Gary Jonas, the owner of the Howe Group, the company where I hang my real estate license. Gary and his partners have over 1,000 apartment units. They also build units from ground up. They have a management company and a construction company. He's a mentor of mine, a really good friend. He's invested alongside me and vice versa over the years. You'll learn a lot from him. He's a great dude. He started with a vision of buying one single family house a year for 10 years when he was younger, to now he owns 1,000+ units. So for anyone that hasn't started or is on the path, always fun and enlightening to learn from someone that is a few steps ahead. So I welcome you to register for that. I might try to do that on Zoom as well, because it is only 20 to 25 people, and I expect some waiting lists on that, but I'll keep you posted. Any other questions before we wrap up for today?
Oh, thank you, Sean.
Thank you.
Hey.
I'll be hosting a webinar every month that I don't host in person. And I will send you, if you email me or reach me through the website, I'll add you to my investor database and keep you posted of any opportunities and also any events that I host. Well, thank you all. Thank you for joining. Thank you for anybody that's watching this recording later. And I look forward to hopefully connecting with you all soon. Have a great day.
Thanks. Bye-bye.
Thanks, Sean.
Thank you.
Thank you.
Thank you.